So you are staring at the chart. 2 hours ago, you bought the dip. The second the price touched your moving average line, now you've been stopped out. And the market, it's rallying exactly to where you predicted. You got the direction right, but the entry, dead wrong. I call this touch trading. And for my first 2 years, this habit did not just frustrate me. It nearly wiped out my entire account. The problem is that you're treating your trading indicator like a CEO when it is actually just a junior analyst making a suggestion. To fix this, I installed the CEO rule. It's a binary 2-step execution filter that forces you to veto any trade that hasn't been signed off by price action. Here's how you stop guessing the bottom and start trading the proof. But to fix this, we first have to fire the person currently making your trading decisions. Most part-time traders treat their trading indicators like a GPS. When it says turn left, they turn left. When the moving average says support is here, they buy. But here's the hard truth. Doing this is not trading. It's obeying a lagging mathematical formula that has zero authority to tell you where to risk your money. It's like letting the lowest ranking employee in your trading business make the CEO level decisions. And it's the primary reason you keep funding other people's accounts. I want you to picture a corporate boardroom. You are the owner. You have an eager 22-year-old intern named EMA. His job, research. He runs the numbers and says, "Boss, the price is nearing the 21-day average. Historically, this is a good value zone." That's useful information. But have you ever found yourself staring at a chart, watching the price fall toward the moving average, feeling your pulse quicken, thinking, "It's touching the line. Buy now, before it's too late." You click. But 2 hours later, you've been stopped out again. That sinking feeling in your stomach, that's not bad luck. That's the instant fail trap. Here's what is happening. When your buy order gets filled, the second you click, it's usually because the price is falling with enough momentum to run you over. You are not getting a good deal. You are catching a falling knife. And data confirms this. Entries that wait for the market to calm down bleed far less cash. Between September 2018 and March 2019, this was exactly how I bled 11% of my account. I was trading late at night, midnight, exhausted from a full day of work at the bank, and I didn't have the mental energy to wait for confirmation. I just saw the price action, touched the line and clicked buy, hoping the line would hold. The result wasn't just a loss. It was a humiliating 20% win rate. That little dip below the line, that's the market testing liquidity. That's the intern being wrong. I was letting the junior analyst run the company, and CEOs who let interns make million-dollar decisions don't stay CEOs for long. The fix is a complete hierarchy shift. You need to demote the EMA. From today, the EMA is your junior analyst. Its only job is to suggest a value zone. It can say, "Look here," but it can never say, "Execute." Now you are promoting price action to the role of CEO. Only price action has the authority to sign off on a trade. And here is how this works in practice. The junior analyst, like the exponential moving average, brings the proposal. The CEO, price action, reviews the evidence. If the evidence is weak, the CEO vetoes the trade, no matter how good the line looks. And this is not a small tweak. This is a mental rewiring. You stop asking, "Is that line holding?" You start asking, "Has the CEO signed off?" That single question changes everything. Because now you are not reacting to a line on a chart. You are waiting for proof that the market wants to defend that level. The moving average just suggests, but price action is what decides. In the corporate world, a contract is not valid until the CEO signs it. And in trading, the specific signature might vary, but the principle remains. The market must prove that it wants to defend the level before you risk a dime. For my trading, and for anyone who only has 30 minutes a day, one of the clearest and most undeniable signatures is the tailed bar. Some call it a pin bar. That same concept. Think of that long wick or tail not as a line on a chart, but as proof of rejection. Sellers tried to push the price down, but buyers stepped in with a massive volume and said absolutely not. They pushed the enemy all the way back. The length of that tail tells you how violent the rejection was. A small tail, that's a small fight that could go either way. But a long tail, that's a decisive victory. One side won. And if you enter a trade without seeing this proof of rejection, you are entering a battlefield before the shooting has stopped. You are guessing who will win. But the professional trader waits until the battle is over, looks at the victor standing over the defeated sellers, that is the tail, and says, okay, now I join the winner. And here is the signature validation checklist. The 3 rules of validity. Rule 1, the size rule. The wick or tail must be at least half of the total candles range. If the tail is tiny, it's not a battle scarp, it's just a smudge. Rule number 2, the direction rule. The tail must point away from your trade direction. If you want to buy, the tail must point down, rejecting lower prices. Rule number 3, the close rule. The candlestick must close near the nose or the opposite of the tail. This proves that the rejection was not temporary. One side dominated the entire session. If a setup meets all 3, you have a signed contract. Now, getting this CEO signature right is vital. But ask yourself, do you ever follow your trading rules perfectly and still end the month losing money? It's confusing and it hurts. I built the free Why Am I Still Losing Money quiz to find the answer. In just 3 minutes, it detects the specific trading blind spot, whether it's strategy, risk, or discipline, that is silently sabotaging your results. Click the link in the description for your personalized diagnosis. I designed this tool from my own hard lessons to help you stop guessing and start fixing. But having a contract does not mean you just sign it anywhere. Location matters. The touch trader sees a tail bar in the middle of nowhere and buys. That's just as dangerous. To fix this, you need a system that fits your reality. The 30-minute window before work, where you are drinking coffee and trying not to make a mistake. Think of airport security. Gate number 1 checks your terminal. Gate number 2 checks your ID and scans for weapons. If you pass gate 1 but fail gate 2, you do not fly. If you try to skip gate 1 and go straight to gate 2, you don't fly. Touch traders see like the moving average, gate 1, and sprint for the plane. The market security, volatility, then tackles you every time. You need a binary filter to act as a hard stop. I call it the zone confirmation mechanism. It's a simple 2-question filter that you run before every single trade. Question 1, the zone check. Is the price candle currently on the exponential moving average line? Then question 2, the CEO check. Did a valid tail bar form and close on that line? Check your 3 rules of validity: size, direction, and close. Then the binary rule. If both are yes, execute the trade. If one is no, walk away. Remember, cash in trading is a position. When the CEO vetoes a trade, your no is an active, profitable decision. In 2022, I applied this exact gate 1, gate 2 logic to the S&P 500 index. I looked at the daily chart for the zone, gate 1, then I looked at the 4-hour chart for the signal, gate 2. It did not matter what time frame I was on. The veto power was the only thing that mattered. Because I forced the market to sign the price action contract at the gate, I discovered I could consistently target 2 times my risk on the S&P 500 while cutting out the losses that used to kill me. The whipsaws just vanished. This is not theory. This is the exact process that I used to do. Every morning, my system scans the market and asks two questions, and I execute only when both say yes. Now I know what you are thinking. If I wait for the candle to close, won't I get a worse price? Won't I be late? This is the FOMO whispering. It tells you that the touch traders are getting in cheaper than you. You are the sucker paying a premium. This belief is the final boss that we will conquer. Let's look at the maths of early versus on time. When you enter at the touch of the level, you are entering the volatility ambush zone. Say you have a $5,000 account and you risk 1% or $50 per trade. If your stop loss is 20 pips away, that means every pip is worth $2.50. Now, here's what happens. The touch trader enters at 1.200. They get stopped out at 1.1980 by a volatility spike. That's a $50 loss. 1 hour gone. The market then reverses and goes to 1.2100. They didn't get a better price. They got a tax bill. Now, you see the spike, you see the reversal, you enter at 1.201, 10 pips worse than the touch trader. Let's walk through this. You paid 10 pips times 2.5 per pip. That's a $25 insurance premium to guarantee the bottom was real. You did not lose profit. You paid a small fee to avoid the $50 loss. So here's the shift that you need to make today. The on-time trading system. Stop telling yourself that you are late. Early in trading is the same as being wrong. Touch trading is guessing, but waiting is verifying. When you wait for the tail bar, you are not late. You are on time. Now let's look at the return on investment of these patients, and here's where the numbers tell the truth. In 2017, applying strict filters reduced my trading frequency by 60%, from 5 trades a month down to 2. Let's say you veto just 7 bad touch trades a month. At $50 per loss, that is $350 that stays in your account. Now, the cost? Maybe you missed 40 pips of early profit across your winning trades. That's about $100. Here's the calculation. You paid $100 in premiums to save $350 in losses. That is a 250% return on your patience. Restraining yourself does not slow you down. It is the only thing that keeps you in the trading race long enough to compound. You are no longer the anxious guesser, staring at the line, finger hovering over the buy button, hoping that it holds. You are the systematic executor who waits for the market to prove its intent, and then you strike with confidence. That transformation, that's not a hope. That's what happens when you stop trading suggestions and start trading proof. But once you filtered the entry, you have one final risk. You can pick the perfect entry price, get the perfect CEO price action sign-off, and still blow up your account if you get the sizing wrong. So how do you size a trade? So big you make money, but small enough you can sleep at night. That's a math problem most traders get wrong. I mentioned earlier that a perfect entry means nothing if the maths is wrong. But here's the trap. If you try to follow the standard 1% risk rule on a small account, you are actually mathematically guaranteed to bleed out. So check out this video where I break down the pro entry stake formula that you need to calculate the exact dollar amount required to trade your strategy without blowing up. See you in that video.